Historically, the SRA accounts rules had a reputation of being very prescriptive. In other words, there was either a breach of the rules or there wasn't. If there was a breach, the accountant would qualify the report and send it in to the SRA. This caused a couple of inherent problems. Firstly, the majority of reports were always qualified, sometimes because of a breach that was not the fault of the solicitor, such as when the bank paid interest inadvertently into the client account. Secondly, the SRA received all the reports, and some of the reasons for qualifying the reports were deemed not to be placing client money or money belonging to third parties at risk. Therefore, logistically, the prescriptive approach of the rules created problems that the SRA decided needed to be resolved. Back in 2011, the SRA decided to apply an outcomes-focused approach to regulation. This created the concept of the Compliance Officer for Finance and Administration, known as the COFA, and the Compliance Officer for Legal Practice, known as the COLP. In addition, the accounts rules were overhauled to make them more manageable in terms of affording the reporting accountant more flexibility in deciding whether or not a breach of the rules was significant enough to place client money or money belonging to third parties at risk. In terms of the accounts rules themselves, this would be the start of improvement in the positive direction. Fast forward to 2019, and the SRA concluded that a long list of prescriptive rules was no longer necessary. Of course, in the last 20 years, the way in which firms work has changed considerably with the increasing use of technology and contemporary automated accounting systems. So gone are the days of the old Kalamazoo manual bookkeeping systems where errors could be prevalent, so it made sense to have a set of accounts rules that was proportionate to the modern way of working.